All right, what's going on, everybody? Hey, what's going on? Y'all having a good day? I mean, it's been going pretty good. It did what we were expecting it to do. That's always a good thing. Take what we can get. The ticks are getting negative again, hitting that minus 750. And the AD is rolling back over. But you see how it's really choppy and like pixelated. We don't want that, right? We want a good, clean mountain. Up or down, rolling hills are always good. And then I use a 250 level. Now, you guys probably don't have the real weighted AD, probably are running the other one. So your numbers are going to be different. What you'd want to do is look back. It usually tops out, and then that's where the market stalls. And then you'll see where it passes that top out point and the market really breaks out or breaks down if you're looking down. And that first topping out point is the level that you're going to want to get used to. The numbers are different on the side than mine, but it functions exactly like mine. If you go looking for this thing in the Think or Swim workbook, I made a video explaining why mine is different and how come you have to use a different one. But free is good, right? We don't want to buy indicators. The one that I'm using, I didn't pay for it either, but I picked it up somewhere along the way. And I don't want to give it away because I don't want the creator to come after me and try to sue me for giving away his product. But I went hunting around on the internet and I found somebody who had the same tool, and I looked at the code. It's completely different, but it functions the same way. Obviously, they didn't steal it. They just took the idea and made their own version. So I can give that one away because he was giving it away. I changed that guy's indicator, changed the colors, and added a few things and took out a few things to make it look exactly like mine. Just the numbers don't match. But your weighted AD and mine would function exactly the same. It's a really good tell on the day to see if we have the market strength to continue a push or if we're more kind of a bifurcated marketplace. You know, it's kind of the ADHD, ooh, I saw a squirrel thing. If you can't get the market to focus on one thing and it's going after a bunch of things, then we don't really have that drive. But if they all pile onto the same thing, then we can really get some moves. And that's what this will help us see is everybody on board and are we all doing one thing? And if we're not, then we get this sort of behavior. Not really expecting much anyways, with Nvidia today, it still has to be dealt with. So let me get this little file out that I created a long while back on liquidity gaps. I cannot cover it because that's a Jeremy thing, but I certainly can ask him. Absolutely. What you'll find along the way is different traders come up with their own style and their own approach, and um, we don't really overlap that much. I haven't studied Jeremy's technique, and if I try to teach it, I'm gonna butcher it, just like I'm sure he can't teach mine. So it's best just to kind of hear it from the horse's mouth. That'll get his attention, and we'll let it go from there. So liquidity gaps are not actually a gap at all, and it's a little tricky because of that. And I've got examples of this the same way as I have examples of yesterday's 111 and 1236. One, because I think showing the examples makes it easier for people to understand. But two, it's how I study new patterns that I want to trade. I go and I capture as many examples as I can find, and then I put them all in a box. And every new thing that I learn, I can go back and I can apply it to those setups and see if the new thing that I learned helps me understand or trade that setup better. So here is an example of a liquidity gap from a CPI report. Now, the thing is, generally speaking, we never know when we're going to get one, but we do know when we have the potential to get one. These can happen at any time, day or night. Stocks, options, futures, anything that has price action can create this gap. The funny thing is there is no gap, right? Like that's a full candle. We did not gap at all. But we're not talking about a price gap. We're talking about a liquidity gap. What happens is price moves so fast that we don't leave anything behind, no footprints or anything. You can see that when you look at a volume profile, for an example. If we was to visualize what a volume liquidity gap would look like, let's think of a daily candle, a daily bar. It's just one bar, right? I know, Captain Obvious, but one single bar, open, high, low, close. And if we open that one bar up, then we've got more bars inside of it. When we take that logic and we apply a volume profile to it, we could lay out the entire trading day. We just need to see it in a smaller time frame. So here's a 1 day bar with that volume profile. Well, now instead of a 1 day bar, imagine we're talking about one single 5 minute bar. It would still have the capacity for us to go down to a smaller time frame and put a volume profile on it. If we did, that liquidity gap that I'm talking about would very much look like a P-shaped profile. And I think we had one not too long ago. Where was it? Where was it? It was out on the daily. This P-shaped profile is right there. Something that looks a bit like that. And what we're focused on here is this really thin area here and then this distribution here. And this is a P, but it could have been a lowercase b as well. The idea is the quote gap is this, that really thin area where there was no trading activity, or it was so thin that it was not leaving any structure behind. Generally, when price moves up or down, we'll use this down here, it's making waves, right? It's moving both directions. There's traders getting out, traders getting in, taking their place, and it leaves all these structures behind. But if we just run really fast, we don't leave any structure behind. And what happens is we can move back through that structure really fast because we didn't leave any footprints behind. We don't have anything back there for support to hold us up or to hold us down if we go down really fast. So while these can happen anywhere, I like to focus on the ones first that we know could happen in a particular spot. CPI, PPI, non-farm payrolls, those are all really common ones. They happen at 8:30 in the morning. We know they're coming. We can prepare for it. And then I've got a set of rules for how I want to trade it. For me, when it comes to the rules, I want price to close in the upper 25% of this bar. I know that that doesn't sound like very much, but it's a really big deal to me. If we close less than that upper 25%, then it indicates a lack of bias, a lack of strength, uh, like they didn't want it. They're already starting to fall back down without even keeping the structure up, anything like that, right? I also don't want any wick on the other side. Now, I'm being very specific about what I want because if I'm going to trade it, Those are the things that I really want to see. But they're not all tradable as far as I'm concerned. And at that point, even if I don't want to trade them, I can still use them in my analysis. We can measure these things and we can plot the 50%, and then we can project 111 and 1236. But if you do measure these and you plot them, make sure you plot 1.5 and 2.0 also. The reason why is because these are event candles and they happen so fast that a lot of times it'll punch right through 111 and 1236, and we'll end up having to go all the way to 1.5 and 2.0. It's just because of how much push there is behind everything, right? So think about how a candle opens or closes, right? And this is going up, but it could have gone down too. We're focused on the upper 20 to 25%. And if it's down, then we want to focus on that lower 20-25%. But look at the way that it is written. If this candle had opened and fell down, closing near zero would be very bearish. Closing around 20% would just be kind of bearish. And then we get into the neutral zone, and then the bullish, and then very bullish, right? It's a sentiment gauge. So we want to kind of keep that in mind. How do these candles close? The depth behind the move lines up with some economic trigger that pushed us. But look, it can be a tweet from the president. It could be, the Walmart CEO chipping his teeth. Anything that suddenly jolts and shocks the market up or down and creates a candle disproportionately bigger than anything else around it. That's what I call a liquidity gap. If it's wicky on both sides and we close near where we opened, sure, we could probably still call it a liquidity gap, but I wouldn't trade it. I don't even want it, right? I would measure it and project from it, but if it closed near where it opened, then there is no gap to close, right? We already went back to where we started. In this example, we never closed the gap. We stayed away from it the whole day, but we did come down and try to check that mid. This one, we did close the gap. Now, I don't think this was a CPI, but it was another 830 print. So PPI, non-farm payrolls, whatever it was. We shot up like a rocket. We closed in that upper 25%. We paused around the halfway mark, and then we got the gap closed by around 10:30 or 11 o'clock. That's the way I like these to play out. But look, they can happen anywhere. You can see over here, for an example, was another one. That's another liquidity gap. It's not as good, but it still counts. And if we'd have had time that day, I would have anticipated that that got closed. You can even get multiple candles. It doesn't have to all end in the first shot. So these two right here, back to back, see how this one closed at the absolute low? And the next one really didn't try to fight the feeling at all. And it just continued on down. That created a quote liquidity gap, and price ran right back up there and got that gap closed, but we were not able to get through it. So you want to put these on your radar whenever you spot them, and they are very useful. Just be careful of how it was created. Yeah, I don't know. I've seen people throw out things like fair value gaps. I threw all that stuff in the trash. I didn't go through any of it. I have no interest in it. So I'd have to Google what fair value gap is just to see if they're even similar. You very likely know more about whatever the hell that is than I do. I tend to just do my own thing, and I leave the other stuff for other people. So I call this a liquidity gap. I know that on jigsaw, when you go through the jigsaw videos, they will often describe how a candle like this is created by talking about a gap in liquidity, which is why I name it a liquidity gap. But that's looking at order flow tools and, watching how candles are created. I don't know what a fair value gap is. I don't really care to know either. I guess it'd be a simple Google search. So you get the big push. These big pushes can happen anywhere, but what created the candle becomes important, right? If it's an earnings candle and it looks like that, I would not treat it as a liquidity gap. It'd probably still be on my radar because I'm sure by now you've all seen that I'll take any big bar that we get and I'll focus on it, cut it in half, mark its edges, project from it higher and lower, but I wouldn't treat it as a gap that needs to be closed because it's an earnings event and they live in their own little world. All these 831s, by the way, if we are going to close them, a lot of times they get closed by 11 o'clock. Here's another one, same thing. Multiple candles to the upside. 10:30 and 11 o'clock, we got the gap closed. Now, in some of these examples, we had multiple liquidity gaps in the same day, and they got closed in that same day. This is what I don't want to see, by the way. If it's a really big bar like this, there is no gap to close, right? If we opened here and we closed there, we're so close together. Look at that very next candle, it closed anyways. I'm not going to see that and try to get a liquidity gap from it. But a big candle like that, we can still measure 50% higher. We can mark the mid and we can anticipate that price is going to respond at those spots. Same thing here, another big bar, mark the mid, anticipate 50%, 100%. So I'll use them, but they're not liquidity gaps for me. This one had multiple liquidity gaps in the same day. We had this one here, it got hit again. This was a triple. Really, it started up here and it was just a nice little run. That's also called one time framing, but I don't really like to say that if it's only three candles. It doesn't really seem to fit. I know I had another one that was a better example of multiple intraday gap closes, liquidity gaps that close, but I'm not finding it. Probably in another file. So these liquidity gaps, if you get them intraday, they're a good tell on where's price going to go. They're very likely going to go back to that spot. The thing is it doesn't owe us that immediately, right? It's not like we expect price to just turn around and run right back over there now. It can take its time. The first thing you want to do when you get one of those is mark where it opened because that's the destination, right? That's where we want to get back to when it's all said and done. Now, I do most of my intraday charting on a 5 minute. So the big candle that I'm looking for is a big 5 minute bar. If you spend your time on a different time frame, then you're going to have to try to get used to what it looks like for you. I know what a 5 minute liquidity gap looks like because I've got so many examples of it and I trade it and I focus on it and I hunt them down. If you're using some other time frame, you're going to want to go get examples of those, and it can be just a smaller one or it can be, an 830 print. That's always a good place to start. Ones where they happen. I was going to zoom back and show you guys some, but since the government was closed for over a month, we haven't really had some good ones. Yeah, we could See if Google's got one. Yeah, see, that really fits more of like a one-time framing because we really do want it to be a single shot. I'll take them if they're triples like this. I will. I'll take it, but the best ones are just one big, solid, beautiful bar. But this, yeah, this left liquidity behind, and the gap that it created needs to be filled. See how we came back to the half and checked it? We weren't able to keep it, and now we're headed back down. We will get that gap filled, right? The question is when it comes to all of those gaps that we always say needs to be filled, it will get the gap filled, but when, right? I can point out gaps that are on the S&P from way back in like the 3200 area, and they're still not filled. So I know they say gaps always fill, but at some point, you just give up on it. So the ones that are tradable for me are the ones that I tend to focus on the most. And then, secondly, the ones that I can use for analysis. They're still valuable. They're just not as valuable as the ones that I can trade, right? Because I want the ones that's going to make me money. But if I can use it for analysis, likely I'll still be able to make money from the analysis, even if I can't make money from the trade. It should be directly connected to some event that caused the move to happen. If you just look left and find bullish price action or bearish price action where you had 3 or 4 or 5 bars in a row, don't look at that and go, oh, yeah, look, there's some liquidity gap right there. I mean, did we run really fast and likely leave some form of a gap in liquidity? Yep. But I'm not going to try to trade that as a liquidity gap, right? For me, I'm very nuanced and very specific about what I'm looking for. And while I might take multiple candles, especially if it's a CPI, PPI, non-farm payrolls, I'll definitely do it there. That's not what I want. And if it's not one big, beautiful bar, I'm probably just going to mark it and not trade it. I'll mark and trade after the gap. So the 111, the 1236, the midpoint bounce, things like that. But I'm that way about a lot of the things that I trade. It needs to be exactly what I'm looking for, or I'm going to throw the dang thing in the trash and focus on something else. I've found that being picky, while it lowers my occurrences, increases my profit significantly. And I don't lose my confidence trading some trash and then wondering why my strategy doesn't work. No, we don't want that. So, liquidity gaps, they are fun. And adding the profile will really help, right? So if you get a single bar and you have a platform like TradingView where you can go in and use the drawing tool to put a volume profile on a single bar, then that'll help you show how that bar closed, right? And you'll very often be able to see that P shape or B shape profile where price ran up and then it has a big distribution across the top with a point of control up there like that, or it dropped really hard and it distributed it at the lows with a point of control down there. It's that tail that it leaves behind that it even has the reason to be called the liquidity gap in the first place because we outran liquidity. In in Bookmap, they got a lot of educational videos that talk about the dome or the what do you call it, active trader here on Thinkorswim. But if you look at the dome, every one of those ticks could be considered a floor or a level that you've got to work through. And if it's really thin, then we'll just go through it relatively easy. But then there's also, and this orders on the dome are, of course, unfilled positions, right? Those are active participants trying to get in or get out. And then you have the volume that you can add to that that can act as support or resistance or interference levels that we have to get through. So if we drop really fast and we outrun all of these orders, then that's the gap that we're talking about, right? We can see how as we go down, it's got a decent number. It was 27 and then 18. Now we're at 23, but it's much higher than the other side while we've been looking at it. We were falling down because the number on the left was lower, it's a skinnier, thinner, whatever language you want to use. We were falling through those levels easier, and we had a lot of structure overhead. But what if we fell really fast and we left those numbers behind and it got really thin on the right side? Well, because it's so thin, we'd likely be able to run back up through it. Doesn't mean we would run up through it, but we'd be able to run up through it easier because it's thinner. There's a lot to order flow. Bookmap, Jigsaw, those are the two most popular. But yeah, the liquidity gap phrase comes from that sort of logic. So the one that I like to trade the most are these ones where we know they're coming. These 8:30 liquidity gaps. I love these the most, right? I don't trade between 8 and 10, and these usually close between 10:30 and 11. So for me, I let the gap form and then I see what are we going to get next? Are we going to consolidate base and then try to move higher, which would negate the gap getting closed? Do we fade back and check the mid before coming all the way down and getting the full? I want to see how that gap starts to play out. Now these 8:30 prints, they generally close before 11. Well, yeah, before 11, but often around 10:30, especially in the examples that I've got here. And I didn't cherry pick these examples. That's just where they tend to close, right? 10:30. The other one is 10:30, close to 11. Nearly all of them check the mid, get a little pullback there, and then they work their way on down. So we can study these past examples to get a really good idea. Did they base near the top and give us anything to work with? Did it just immediately reverse and start coming right back down? Right? We can't just write a little note that says, okay, we got the candle, and after it moves X amount, I'm going to get in. At least I won't do that. We got to try to evaluate what is it doing. This one, by the way, never closed. So this is a really good example of getting the gap, a perfect gap, and not getting a gap fill. I always like to add failures so that we have a good idea of what they look like. This one based really well, and then it just kept right on going. Now the measured moves worked, so we could have played that. And then it rounded out nicely. It offered a short pattern off the highs. We could trade that, but it never made it through the mid to get back home. Once the liquidity gap has formed for these 8:31s, the clock is ticking. We got about 2 hours, maybe 2.5 at most. I'm not in any hurry. I don't like to trade before the bell in this scenario. So we let the bell ring and see if we got that opportunity to get in here. Now, me, as long as I got a destination, say we're going down or we're going up, I'll begin to start looking for my opportunities to get in to go short because we're going down or to go up because we're going up. This candle itself is not the trigger, right? And passing X% wouldn't be a trigger. But if we can get a reversal bar, if we can get, say, an evening star or a morning star, if we break the mid and get a really good wick reversal, a 1, 2, 3, 6, 111, 3 bar swing low. Once I got the destination and I got a signal, I'm good. Just run it. I'm not focused on getting 60% or 50% of this trade. I don't want to run it all the way back to where it started. I'm not that trader, right? I don't care to get in and hold on until it finally makes it back to where it all started, because that's not what I do. So I'd get 5 to 7 points along the way. I'd call it good. I'm done and I'm out. Somebody else, I'm sure, is going to put their stop somewhere down here and they'll hold on for dear life. And as long as it doesn't hit their stop, they'll ride it all the way back. But that's certainly not my approach. I'd love to get the money of 100-point trades, but I am not interested in sitting in a trade for more than 5 7 minutes. Certainly not 2 to 4 hours waiting for price to play out. Liquidity gap, pretty cool. Just keep in mind, even if they're janky, if they don't ever give you a gap at all, if they're just these wiki boogers, measure them out, plot the midpoint, mark the high and the low, and then project 50% higher and 100% higher and lower, right? Not just up and down. But use 50 and 100, not my 111 and 1236, because they were made with such violence. Usually the 111 and the 1236, it'll just run them right over. So maybe if they're wiki like this and they close in the mid, maybe you could use the 111 because it's got to work its way all the way back up and then break out. But if it closed near the high or near the low, I would not project 111. I would project 50 and 100, because the strength of the push is going to be too violent and it'll just rip right through them. We can go back on Thinkorswim around 90 days before I lose the ability to keep a 5 minute chart. So we can find some CPI, PPI here, or I can jump over to TradingView and do it. But we haven't had a CPI, PPI, and none of those for a month, because government's been shut down. So that's August. That'd work. August, usually around the 7th or the 8th. There we go. Look at that. Looky. 830 print. That's a really good example of a liquidity gap. First, let's focus on what it does, and then people can decide for themselves, how would you like to trade it? I call this destination trading. Okay. What do you do in destination trading? If you know where we're going, how are you going to participate in getting that trade? I read this really good book once where they were like, traders, you can literally tell them that the S&P is going to close at 6460 at the end of the day and they will still lose money. You could rewrite the future and tell them exactly where it's going to close, 6460. We will be there at the end of the day, and traders will still lose. Why? You know the destination, right? And that got me thinking a long time ago about how I trade. So I tend to focus on, what's the destination? Where are we going? If I know the answer, great. If I don't, well, I try to work it out. But so this is the destination. How am I going to trade that? To even answer that, we first want to consider, what is the liquidity gap supposed to do? Well, it's supposed to go back to this spot. So any checks or balances along the way that tells me it's not doing that abandons the trade. This one that I found, I just scrolled back and found August, probably non-farm payrolls, I'm thinking, because of the date, but it could be one of the others. It didn't close the gap. It got hung up at 50%. And that's where it hung up, made another run, set that lower high. We got the lower low, and then everything turned around. 10 a.m. news popped us, broke the whole thing, and away we went. But the 10 a.m. news broke it. Otherwise, it very likely would have come down and closed that gap. There's also the idea that we can trade this mid here too, and that's where it stalled out. I think I missed that. Yeah, I mean, it was close enough. So both of those mids got hit. So this one didn't go back to gap close because of the 10 a.m. news. But how do we trade it? Well, some traders are going to get in as soon as it quits showing that the bullish impulse is done or bearish. And they're going to get in right there and they're going to hold it until either that trade loses because it gets stopped out or it comes back down and trades the gap. If you're that kind of trader, then that's how you're going to trade it. It's not how I trade it. I don't trade between 8 and 10. Generally speaking, I don't even look for trades between 8 and 10. So a rare possible occasion I do it, but I don't even bother looking most days. So I'm not going to trade this until after 10 at least. And it gives me a setup, a 3-bar reversal, a break of the mid, some pattern that goes with it because I already know the destination. We're coming back down here. So after 10, 15, 10:30, is the gap closed? Nope. Are we moving in that direction? Yep. All right, let's see what I can get. Why? Because I already know where we're headed to that spot right there. This was a liquidity gap too, by the way, on that same day. So we got this one, then we got that one, we got that closed, and we just kept on running. We never closed the first one, not that day, because news popped us. Looks like it only looked good when I was zoomed out. Once I zoomed in, it didn't look too good. See, we got another one. Yeah, there's a really good example of a liquidity bar. Look how big that is compared to everything else around it. And then what did we do? We went back up. All right. So a couple things you can measure. You can measure the mark of that bar because that's really where the liquidity event happened. There's the mid. But you also need to mark the entire run. And you have that mid. So you got the reversal bars, this one and this one. We were triggering into stops, big buy orders that just shot us to the upside. They weren't able to keep it and it dropped down to the next level and then it tried it again. So they fired it off and then they doubled down and fired it off again and was able to hang out around the mid of that first bar. And then we got back up here. This right here, where we drop down and come back up, breaking above that bar, I like trading that. It's a really nice reversal signal. I trade it often. I even made the little sticker that we put in the Discord that shows that very same trade. That sticker right there. Now, the sticker that I made, of course, has the third bar, but you can do a 2-bar. It doesn't have to be 3. For anybody watching the replay, we're talking about this sticker here. Price drops down, you get the reversal, you get the breakout bar. The little lines pop up showing where to get in, where to put your stop, all that good stuff. So that's generally what I'm looking for. This is just one reversal bar, one reversal style. It can do a tweezer bottom. It could have been a hangman, dragonfly doji. I don't. I just need to see some kind of reversal down here, right? Then we play the destination. What's the destination? Back to the top, because that's where we started. And along the way, we got these little micro ones, but I wouldn't have been using them, right? That one there, even this, I guess, right? But it just starts to turn into a mess if we start tinkering with it. That was the boss. That's the liquidity gap that needs filled. That's the target. So then the questions start with, well, how do you trade it? Right? How do you trade it? Me, I'll do it in futures, but what if it's equities? I mean, you can do it in options, you can do it in stock. We could sell puts, buy calls. This trade is very much like the 111 and the 1236 in the idea that we know exactly what it looks like and we can go back and find all kinds of examples. Save them, study them. If you use indicators, you can apply indicators to them and really dig in to be able to answer questions like, what did I see in that picture that I would consider tradable and where would I get in it? Because it's very likely that the next time we get one, it will look similar to one of the examples you have, right? And these examples, a lot of the examples look exactly the same. This doji one isn't too far off from that doji one or that one, right? You'll start running across these overlapping pictures. And at that point, you just start playing a game of mahjong. I will say, if you want to do it with options, not these 830 ones, right? Because the only options you have at 830 are the futures, but the intraday ones. It sounds trickier than it is, but you want to try to go the opposite direction while it's still moving, right? So when it's still falling down is when you want to be buying calls. And if this had spiked to the upside and you thought it was going to be a liquidity gap, you would have wanted to be buying puts before it rolled over. That's my approach because the risk is less if you do it that way. I know it doesn't make much sense if you don't trade options, but options values move based on more than just the price of the stock and having the stock move, right? Options prices move because of the Greeks and because of the stock and volatility and all kinds of things. If you wait for the stock to go down before you buy a put, by the time you do buy a put, that put is going to be very expensive because everybody's buying puts because the market is falling. And if you're wrong, that put is going to lose a lot of that fluff, a lot of that juiced up premium that was in there because every Joe Schmo and their brother was trying to buy it the same time you were buying it. But if you bought that put while we were still going up, when nobody wanted a put, you would have been able to get the put cheap, probably cheaper than it was actually worth because nobody wanted the puts. And the guy who had the puts was just begging for someone to buy it because we were still going up. And they were thinking, oh man, I don't want this put. For goodness sakes, somebody take it. They'll probably give it to you cheaper than it's worth. And yes, you can still lose, but that put that you bought cheaper than it was actually worth, when it does lose, it will lose way less money than the put that you bought that was crazy expensive. So you won't, quote, lose less often. You'll just lose less money. And like we continue to talk about every Wednesday and Friday, I don't care about winning and losing. I care about how much I lose when I do lose versus how much I win when I do win. Because we can't avoid losses, right? Losses are going to happen no matter what we do. I just want to keep those losses small. So if you are trading options and you're not doing that, just try it out on something really cheap. Say, XLF. That's like one of the cheapest intraday ETFs that we have. That the XLI, XLF, XLB, XLV. Well, maybe XLB is a little much, but XLF is a cheapie, and it's the banks, right? This little booger, it can move. So it's a good one to experiment with. It's not exactly the most liquid darling in the world, but it gets the job done. And if you're wrong in here, you're not going to break the bank. I don't like to lose money any more than anybody else, but look at what you're dealing with. $14, $30. That sounds a heck of a lot better than 1400 and 3300, like some of the other markets that are out there, right? So give it a shot, see how these options really do work when you're right and when you're wrong, when you're early. Because, oh boy, if you're trading options, you want to be early. You don't want to be late. You don't want to wait for confirmation. Confirmation is so expensive. And you can still lose even after waiting for confirmation, right? That's the worst part. You pay for it, you get handicapped by it, and then even though you waited for it to confirm, it can still lose. Well, if it can lose anyways, you might as well make sure that you get the least amount of loss possible and the best possible profit if you're right, because they do pay out really well when you're right too, by the way. Not only is the losses smaller, the profits bigger. But you got to change your mindset and get in before there's any signal that it's time to get in. Like going long today on XLF, knowing me, I would have probably tried to get in this somewhere up here. I mean, I don't trade in this window, right? This 9:30 to 10 window. We're just talking about the move. I would have tried to probably get in right here to buy calls when nobody wanted calls. And after it failed, and got all the way down here and then started going up, I would not be buying calls in here. I would not buy calls anywhere in there. Very likely wouldn't have wanted to buy calls anywhere after that first candle, that bounce. But I think even that first bar is probably too late. So you can dump it, right? You buy the call, that much would pay you. You could get out of the call with profit, not much, but you could get out. Saves you from losing. And then you could try it again. But this little run here and trying to buy a call while it's still falling, I don't know that that would have been enough. Maybe, but I don't know. I don't think it would. During COVID, all these little fly by night wannabe trading places started popping up all over the place, and they were communities of traders, and all they did, well, they said traders. All they did was intraday traded things like Tesla, SPY, mostly SPY, and they would just go long. Every day they'd go long. And if it fell, they would definitely go long because they were right most of the time, right? So they would do that. They would go long over and over and over and over again. And if it was actually a bear market day, or if we actually slipped into something like the 2022 bear market, those guys didn't do so good, right? But it would take them about a week to realize that the buy the dip wasn't working, and their community would suffer horribly because they'd be getting their butt handed to them. They couldn't really read any technical analysis. All they had was the guts to buy it as it was falling every day. That's all they had. I'm looking for some examples of that, but we've been kind of topped out and fluttering across these highs for a little while now. Yeah, we didn't have any good examples. But those kind of communities, that's pretty much all they had, was just the guts to go in and buy it when it was still falling. Buy the dip over and over and over again until that doesn't work, and then they just get ripped apart because they don't know how to do anything else. Now you can use these liquidity gaps on the bigger time frame, like I mentioned, but they're a little different out here, right? If you're doing them on equities, make sure they're not earnings gaps or dividend gaps or something like that. You want them to be more naturally created, less anticipated like that, I guess. We anticipate CPI and PPI, but I don't know, it's just not the same thing. Otherwise, the biggest bar, what we would focus on as like a liquidity bar, it still becomes the boss bar too, right? We expect to get back up to where we started, and we have to get out of that bar before we can do anything else. And we can run the mid on that bar. So really you can use them anywhere. And then of course we can project from it. That one, but I don't want to mess my lines up again. Let's use one that I don't use. Yeah, something like that. Except it didn't extend to the right. Yeah, it gets the point across. 50%, 100%, 150 to the upside, 50, 100, 150. You're measuring that bar, right? The mid. So if you're day trading a lot, you got all these different levels, right? The gap close, the ADRs, the quadrant lines, the floor pivots, point of control, value area high, value area low, yesterday's high, low, close, global, all these lines, right? Which is why I say I'm a pivot point trader. Doesn't really matter what the pivot is. At the end of the day, you really want a really good tradable strategy for reversals and continuations. I expect more often than not that when we get to the lines and levels that I mark, we're going to reverse. So I spent a lot of time focused on reversals, things that look like this. That's a really beautiful reversal today. Here's one that was put into the chat. I'm going to bring over too. This looks really good. So when it comes to these reversal bars or reversal patterns, put a lot of detail into them. Just put a lot of thought into it. Consider anything that you can add to help you better recognize where they're supposed to happen, and then have a plan for what are you going to do with it when you get it. Are we supposed to go short there? Are we supposed to continue on from there? Right? What are we supposed to do? This was a little bitty liquidity gap right there. I mean, it's a little bitty one, but it still counts. Kind of got a itty bitty one down here. I don't know if that one's going to get closed or not, but see these littler ones, I'm kind of iffy about using them. But I'll tell you, in the middle of the day, a lot of times I'll mark the midpoint of those bars and I'll use them as my focal point. The midpoint becomes really valuable, even if they're not going to be, quote, liquidity gap candles. They're candles of interest, and I put effort into them. On Trade I will mark them with a volume profile all their own, or I'll start a profile right like on the candle before, so it captures that candle just to mark where the greatest amount of volume was in that bar. All right, so a little bit of candle 101. I think this will really help, right? And if you have not read a candle book, I'm not one to throw stones, right? Trust me, because I didn't read a candle book for the first 3 years that I was trading. I focused on options when I first started. I couldn't even do technical analysis, right? I didn't know about indicators. Like I could read price like anybody else, oh, it's green, it's red. But I didn't read any analysis books or study any candle patterns because I focused on candles first or options first. So that when I did go back and look at candles, you know how silly it feels to read a candle book when you've actually had money in the market trading? You know what I mean? Because when I finally got around to a book and they're like, that's a wick and that's a body. And I'm like, no, no kidding, Captain Obvious, right? Like get to the good stuff. But don't skip ahead in those books. Work through the obvious stuff, and pretty soon it starts to get into things that aren't so obvious. And yet they're really awesome beginner stuff. If I had taken the time to study those earlier, it would have helped. I wouldn't have struggled so much, right? But it just feels silly reading a candle book that is pointing out wicks and bodies. I get it. When you've already been trading, you don't even want to think about wasting that kind of time to go through that. But you kind of got to at some point because it'll transition out of that and get into the deeper stuff. So there's these patterns that I really like, and I listed them here on the side of this image. And candle sentiment is a really simple concept, but I'll tell you, I see people overlook it all the time because they're not thinking about it that way. So, where price closes inside of this 100% helps us with that sentiment. And then we can think about the patterns for reversal or the patterns for continuation. We just had one of these patterns not too long ago. Topped out, started to fade, put in a 1, 2, 3 fail, and oh boy, down it went. There are thousands of patterns, guys, thousands. I don't know them all. And there's new patterns being made every year. Somebody was talking the other day. They used a phrase. I say the other day, but I'll bet it was probably 6 months ago. But they used a phrase, seek and destroy. And at the time the pattern was not very bullish or bearish, and I was like, that's kind of an aggressive attitude. And they're like, that's not my attitude. That's the name of the pattern. It's called seek and destroy. It's a profile pattern, a market profile. Like I didn't even know what the heck that was. I had to go look it up. And it's new. I mean, it's been around for a little while, but it's new, all things considered. But the funny thing about seek and destroy is it activates at the 111 and the 1236 when you get outside of a range. So it still fits my style, even though it wasn't something I'd ever heard of. So what I always recommend people to do is rather than trying to guess what pattern you want to study, go back and find some of the trades that you would have traded if you could have seen it coming, right? Like I don't know, the reversal today, for an example. If you wanted to trade that reversal, what is that reversal called? Right? You figure that out and then you go read about whatever that reversal's called, and that's the thing you study. Or if it's a tweezer bottom or a tweezer top or whatever it is, because if we're going to trade reversals, it's going to be a reversal pattern. You could even go to Google and just type in reversal patterns and see what pops up. Tweezers, dojis, 2 bar, 3 bar, those are all really popular. And they're ones that I like for sure. Then there's the bigger reversal patterns, the cup and handle and the double top or inverse cup and handle and double bottom. I trade those too. My way, not the textbook. What I don't like to trade is this stuff. I have no interest in trading that. Or if it looks like that stuff, I don't want that. I don't want this. And usually when I point those out and I say that's not what I want, most people say, "Yeah, me neither, but how do I know it's going to do that?" Until I look back and realize that's what it did. And I was trying to trade it and I got my butt handed to me. I get that. There are some tells along the way. So when you're looking at the market, start with where would you like to get a trade? I know it sounds funny because, like when we go car shopping or looking for a new pair of shoes, you already know what you're looking for. The thing is, when it comes to trading, you should already know what you're looking for. Otherwise, how are you going to know that it's there? If you don't know what it looks like, how can you trade it? I wouldn't mind trading off of the breakout of this high or trading off of this low as long as it fits inside my rules. I don't generally trade in power hour, so it would need to get there, you know, before power hour. It would need to give me a trigger to get in, either one of the reversal patterns that we were talking about or a continuation that demonstrated um, a continuation. So, like a Busby would be nice, which would be a pullback to support after breaking through old resistance. Something that tells me it's time to get the trade on. So we can see we're breaking through the mid, and it's the real mid. I didn't use the body down here. We need to close above the mid. That'd be step one. Two, not be past 3 o'clock in the afternoon. And then I need a continuation signal. So a continuation would be something like a Busby. Busbys are continuation patterns. Or if I want to get aggressive with it, once this bar closes and needs to close in the upper 20%, then snap the mid on that bar once it closes and try to catch an entry on the pullback to the mid of that bar. And that's if I wanted to get aggressive, because I think we've all been there where, we're waiting on price and we're like, okay, it's going to break out and we're going to wait for the Busby and then we're going to get in. And what's it do? It just breaks out and runs to the freaking moon. And we're sitting there waiting for a pullback. Yeah, that sucks. So I came up with this as a way to still let me in, right? If it's going to be one of those runners where it just doesn't stop, this will get you in. You might have to sacrifice on the pullback, but we are looking for a pullback, right? Use this drop down as an example. No wick on the high, no wick on the high, no wick on the high. You wouldn't have wanted in, right? There's the wick, there's the mid, there's your entry. Well, that's a long wait, right? So how the bar closes can be your entry point on this. Since there's no wicks on any of these, but it was pulling back, you can use the pullback, wait for the candle to break that candle's low, and then get in. So you need this one to close. There's our bullish push. If it closes on a pullback and we get no wick, then you're not going to get your mid, right? You can give up on the mid if you don't get a wick. Let this close, say, like right here. Now it just closed. Nope. Still no wick. You can get it on the breakout, right? If there's no wick. Break above that bar, there's your entry. If we had wicked, then you'd have been looking for the half. You wait down here, catch it off of the mid, get in on the mid or on the way back up after the mid. But this didn't have a wick underneath it, just like this didn't have a wick underneath it. I feel kind of blind. We don't have my top of book, or we don't have full book. I only got top of book. So this is tactic, right? Tactic is unique to each person. You want to pick up on these, but you want to adapt them to suit your needs. See how that came right back down again? So that would have took out a stop, or for me, I probably would have scratched it at one or two ticks up here. It definitely is a trade that didn't work, so I'd be out. But it wouldn't be a big loss trade, right? And I don't care about getting a scratch like this. Like whatever, it's two ticks. Let's go. Let's go. Move on to something else. But the warning signs that we wouldn't have wanted to trade it anyways was it's after 3. When it blasted through the mid, it didn't stop. And that we very likely have a Busby down here, right? But if you wanted to be aggressive, that way would do it. It'll do it and it'll keep the risk really small, because that would have stopped me out, but it would have been a very small loss. And the thing is, the trade is still there because this is still open. So if we run up and we break out, then it's still a trade on the breakout. This process works a heck of a lot better when it's right off of a key level, say a reversal off of the lows or a reversal off of the highs, a pause on the mid, and then the next one's the breakout, rather than something like this where we punch through the whole thing in one shot. Yeah, 618 is a real deal. I don't use it, but it's fibs are based on it, right? Like 618 is the magic number. I just because I don't use it doesn't mean that people shouldn't keep their eye on it, because I got this one lady that she loves her 618, and her and I have had like, you know, theologian discussions on this thing. She loves it. She will not get rid of it. Me, I don't want it, but to each their own, right? And man, she really loves it. That halfback held, or not halfback, that ADR held like a boss. So there's the midpoint. Whoop, I overshot that. If this is going to be a continuation, then resolving this midpoint would be a way to do it. And when I'm playing my reversal trades, playing a midpoint like this is a good way to go, right? Just like we can snap the mid here. That's the reversal, right? Yep. So I know traders that wait for candle to close and they jump right in. I know traders that'll pounce on a breakout as soon as it begins to break out. They don't wait. Like everybody's got their own style. So you want to pick up all of these different techniques and weave them into something that suits you because you really can't go wrong, especially if you're in paper, to try out different things and see what you like. And then, it can, depending on the condition or the day, feel free to swap it up anyways. Like I don't always do the same thing every single time. If something is different, I try to evaluate what can I do to get into this differently. And it helps if you have order flow more than just that. That's kind of lacking there a bit. On these runs, by the way, guys, if you get something like this and you want to trade these, we had a name for these in Trump's first term. We called this the parachute play. You would want to drop to your smallest contract, so like the MES or the MNQ, and you have a fixed auto stop attached to your entry. So as soon as you get in, it puts the stop on, and then you just blindly hop on for the ride and you run it for all it's worth. Right now, I don't trade that way anymore, but that's what we were doing with those, especially if they were really big ones. That wasn't as bad as these, right? These really big bars, you get two or three of those in a row, so that in like 15 minutes you win 130 points. When you get that sort of behavior, you just market order in with a one lot, and it runs 30 points and stops you out. Like, what do you care? You just made 30 points in 10 seconds. I don't trade them anymore, but if that's what you're interested in, that's the strategy that we were using. Parachute plays. To me, the better trade is the 111 or the halfback or destination trades like VWAP. VWAP makes a really good destination trade. Put VWAP on today. So when we turn around and we're headed back, that's the answer to the question. Like, oh, we're turning around. Where do you think we're going? VWAP. We're going to VWAP. That's where we're going. Right? You see it all the time. We turn around. Where are we going? VWAP. Even here, we didn't we didn't make it to VWAP, but that was the answer when we started to turn around. Where are we going? To VWAP. So if you're at high of day or if you're at the low of day and price is turning around, where are we going? At the bare minimum, we're going to VWAP. That helps you better gauge, do I still want the trade? So look how this bar closed. I'm focused on this blue bar right there. That bar closed this close to VWAP. There was what, 10 points, maybe 11 points between these two. Now, if from the close itself, not just the high, there was a little bit more room. So 15 points. Depending on the size of your stop, is that even enough room to get a trade? If you're trying to get a 2-to-1, at least 2-to-1, and you've got a 5-point stop, then you need a 10-point trade. You're going to have to nail that thing from the bottom to the top perfectly to be able to get out by VWAP and still make your 2-to-1. That's a really risky trade, and I wouldn't take it. I don't need the risk. And I get it. Somebody's going to say, but you already know where it's going. It's going to VWAP. Why not take the trade anyways? Because it's not worth the risk. It's too tight of a position up here. And look, it was a heck of a fight. Sure, it would have made it eventually, but it was a horrible trade. I wouldn't have traded it up here. It was a better trade when it was reversing down here. This one had this kind of janky tweezer bottom, and it had VWAP. And it probably had the midpoint too, the halfback. Sure did, and it had a halfback bounce. So that was 3 really good reasons to go long right there. But it was still a really sorry trade. I wouldn't have wanted it. So destination trading can help you try to figure out, should I even get in? If you look at this reversal off of the high today, where are we going? VWAP. So destination trading can help you measure that out and say, oh, it's 30 points, half back bounce. It's just like it sounds. So let's zoom into what I had just shown. Let's get this out of there. We had that really big bullish bar close. Now, when I'm trading, I like to get into the midpoint of things, right? This bar closed. I'm looking for a new bar to open. And after price has done a swing low and it starts going back up, we expect wicks on the bottom of each new bar that closes. Right. So this one closes, the new one opens. Expect a wick, and then that bar goes up, and then it closes, and the new one opens. Expect the wick, and then it goes up. Right. And we just keep going up. We just keep going up. We just keep going up. So if I'm expecting a wick, how far can we wick before we turn around and we break this bar and we go up even higher? Well, we could probably wick to about the half. There's a half back bounce right there. Half back bounce. I really like a half back bounce. The thing about wicks, when I first learned about this, I was like in disbelief and argument. You know what I mean? Like at first I was like, nah, no, that can't be right. And you don't always get it, but here's the reversal off the low. This the open of the day and the reversal off the low of this rundown. Wick, 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 wick. So when I was studying candle entries or trade entries, and the prevailing argument at the time was wait for the current candle to close. Don't chase. When the new bar opens, that's when you get in. And I was trying to argue against that. I was in a book, but I've hunted for it so that I could quote the book, and I haven't been able to find it. So I picked it up from a book somewhere, but for the life of me, I can't find out which one it was. But I was trying to argue against waiting for the candle to close and then getting in as soon as the new candle opened. And I came across this that said after a swing low, you're going to get all these wicks on the bottom. And if it's a swing high, you'll get all these wicks across the tops. So that you don't want to get in as soon as the new bar opens because you're going to catch wick, right? So, well, that makes sense. Why eat all that risk if you don't have to? You know what I mean? Like, sure, our stop is big enough that we probably won't eat it, but if we can shave off a point or two and make our stop smaller, then that's even better. Okay, that's awesome. We'll say it that I got it from him because I have read that book, but I don't think it was him. But I'll take it. We'll use that because I have read that book, and heck, I even have it downloaded right now. I could probably just post it in the chat somewhere. So yeah, that's the idea behind it, right? You get the swing low, price turns, starts moving back the other way, and we're anticipating these wicks. Well, that got me focused on how much should it wick, or what's an optimal amount of wick, so that I can try to bottom tick these suckers. Now, if you've been doing this for a while, consistently bottom ticking is not a thing. But I mean, if you can get 3 out of 10, I think that's pretty good. You know, So if you haven't heard the phrase before, it's where you're literally getting in at the most bottom part of that candle's move, bottom ticking it, or top ticking it if you're taking it the other way around. And if you can do that 2 out of 10 trades or 3 out of 10 trades, you're killing it. Keep doing it. Yeah. Yeah. Yeah, that's exactly why I didn't like the the argument that said, well, we should wait for the bar to close and wait for the new one to open and pounce. I thought, why would I want to do that? Because the if I pounce as soon as this one opens, then I'm riding all that heat. And I don't want to ride all that heat. So I don't like to get in as soon as the bar opens, knowing or at least anticipating that there's going to be a wick. I'd rather wait. So if we wait, then where are we supposed to get in then? Which is why I came up with those rules about the halfback is a really good place to target. If it overshoots the half like it did here, then you could wait for it to work its way down, and on the reversal and the way back up, you can catch it as it's breaking up. So entry right there. If you don't like that entry, as it goes up, it breaks the close. That's entry opportunity 2. And if you don't like that one, then you can get it as it breaks the high, and that's entry opportunity number 3. So it offers all 3 of those. Yep. Now, I've tried to just put the order on the dome and see how that works. And I can tell you, I know exactly how it works. You'll get run right the hell over, or it'll miss you by a mile, right? It'll do one of these where it barely wicks down at all. Where's it? Probably that next one. Yeah, it'll do one of these and it barely wicks down. So you'll be waiting down here and it doesn't even come to you and it just runs away without you. Well, that's really frustrating. So I don't like to just put the order on the dome. I'd rather, you know, watch what price is doing, and I don't trade the 5. I know it's what we use in the pictures that I send to you guys all the time. I use the 5. I do my analysis on the 5, but I trade a tick chart. So I've usually got my other chart up and I'm watching this on a tick chart. And if you look at, we'll just add a chart here. If you look at this same move that we're looking at, on a tick chart, it looks really different. So that's the 9:30 open. We'll just put it in a, what am I looking for? There we go. How many days did I go back? Oh, well, shoot. Ah, that's today. We should be able to get today. If Thinkorswim will zoom out. There we go. There. You see how much better that looks? So the candle closed, the new candle opened. Here's the candle close. The new one opened and it dropped down, ran right through the half, and then on the way back up, you get the opportunity. Yep, two different drawing sets. So as you can see, it looks a lot better on the tick chart. Um, if you don't have tick data on your trading view, you could use the sub minute charts, but they're not the same. Uh, Tick is tick. You know what I mean? Like you could try 45 seconds or 30 seconds, but I don't I don't think you're gonna like it. I don't have the tick data on TradingView either. It's one of the reasons I keep my Thinkorswim up all day long. But I usually have it on the other computer so that it's not hogging my resources while I'm trading on this computer. I mean, price is price, right? So it should. The problem with equities is to be able to ask the question, why is it moving, right? Because when it comes to the futures, we pretty much have a really good idea why things are moving. It's some macro backdrop, it's dollar bond, treasury yields, blah, blah, blah. But when it comes to equities, was it, earnings, whatever? Because you'll get extremes in equities more than you'll get extremes in the indices. So, if you're not familiar with tick, it is a trade. So if you set the tick to 1,000, once 1,000 trades have come in, we'll get a new tick. We'll get a new candle. I mean, sorry. So it's not how many contracts; it's how many trades. One trade could have 1,000 contracts in it, right? If you're trading in the Globex, it can be boring and wiki and sloppy and a lot of doji bars, and it just sucks. But if you look at that same overnight time frame with a tick candle, a candle only formed if enough trades happened to make it form, and then you get a much better charting experience. You got something to actually work with. There's no right number or wrong number to use, but if you trade SPX, I'll give you one. I think it works fantastic for the SPX. So this is the SPX. Let's put it on a 5 minute so everybody can see what we normally would see. That the SPX. And that's the way I like to see it. It's a 5 minute. It's where I do my analysis. But when I'm trading the SPX, I've got one saved that I use just for the SPX. Why I don't see it? It's 75 tick. 75 tick for the SPX is fantastic. This is 133. It'll do. In fact, I might have swapped 75 for a 133, and that might be because Thinkorswim has 133 as its default tick size. And I remember reading that in an article and was thinking about my 75 tick. So yeah, that's probably why I deleted it. So on the left, we've got 133 tick in the SPX, and I think it looks really clean for trading. If I'm going to do analysis, I'm going to stick to my 5-minute, the one on the right. Look at the granularity of the reversal here versus these here. It's not perfect, right? We're just talking about the opportunity to trade. 33 is okay. On a day like this, I'm telling you, I really miss my 75. There we go. Look at that. And much better. Much better. So if you do trade equities and you're trading the indexes like the SPX, if the candles aren't giving you enough quality to make a decision, try changing your time frames. Look at how this reversal bar on the 5-minute, look at this aggressive push in the ticks. Really awesome. And of course, today's 111 and 1236 reversal. So that's a 75 tick. Don't try that with the futures. It's just going to look janky. But for a SPX, it works really good. For any market you go to, you can use a tick chart. You just have to figure out what does that particular market need. So I went to Apple. 75 is way too small for Apple. So maybe a 500 tick. Yeah, that's not bad. I could live with it. Probably want to tweak it a little bit, but Apple looks good on a 500 tick. And 266.5 is a little dark pool print we may go back to. How you doing? Yeah, that's not bad at all. It's funny you mentioned Bollingers because if you look at the S&P and the Nasdaq on the weekly with the Bollingers, you'll see that we hang outside most of the time, right? Like that's the norm. But we're back inside the bands. I'm gonna swap this out with the Keltner, not the Bollinger. Did you put one in the chat? Yeah, I misspoke. That should have been Keltner. Keltner, not Bullinger. We stay outside of the Keltner most of the time, and we're not outside of the Keltner anymore. So you look at that April run up after dividend in June. We got through dividend, popped out of the Bullinger. I did it again. Popped outside of the Keltner, and we ran it. And other than some dips down, we've been running outside of the Celts till now. Yeah, look at that. That was a gap and go, where a gap and fade, right? The last hoorah. If we take that weekly breakout bar, first it was a gap up, and then it ran up, crossed through the Bollingers and failed. So um, fake, break, fast, fail. It closed below the mid, indicating that the next week was likely to continue its bearishness and put a line in the sand. Then we checked that from below on the next week and we fail. We checked that mid and I ballparked it. That's not a perfect mid, but it's good enough. So on that failure, checking the mid and then on the way down, we broke through the open and the close of the previous week and then the low of the week. And then just what a wonderful drop. Got the gap closed way over here. That'd have been a good destination on the way down. Like, where were we going? And the following week, when it ran to the upside, it was able to get all the way up through that market's open and tag that 50. And then down we went again. I laid it out. I went over to a weekly chart, pulled it up for that fake break fast failure. When we get a gap, guys, there's all these different gaps, right? You got breakaway gaps, exhaustion gaps, liquidity gaps. This, in fact, we did a live stream on gaps a while back, um, which I was gonna. The a gap up at the highs is a dangerous thing, right? We don't want to see those as continuations, and sometimes they are, but a lot of times a gap up at the highs is a really bad idea. So it's a fake break fast fail kind of thing. What I like to do when we get a gap up at the highs is lay out my midpoint and then the low of that gap, the gap candle, and then where we left. Now, some analysts, everybody's got their own way. Some analysts will say if we get inside that previous bar's range, the gap is closed, right? So we'll just zoom in right here. They'll say anywhere inside of last week's bar and the gap is closed. I am not that kind of analyst. As far as I'm concerned, the gap isn't closed until we get back to where the close of that bar was, right? So in this scenario, we closed at 67.91. And for this gap to close, we got to get back to 67.91. So I mark all those out. We get the reversal that we're looking for. Price starts to fall. We're looking for it to break the mid, whatever the mid happens to be at that point. Maybe this low wasn't created then, right? We don't know, but break the mid, get back through our own open, cut the low. And then on the next bar, we still have all of that laid out so that if we try to rally, it will fail out the same way. And look at the next bar. It was also a gap. We closed here. Actually, we closed here on the lower end of this doji. And then we gapped up and failed again. And we closed down here. Oh, I'm sure that some do, but price moves in waves. We need it to go up, right? So that we can fall X distance. And then as we fall, we need it to go up so that people can take profit and other people can hop in and join the short. But yeah, I'm sure that there's also some manipulation that there's some actors out there who can push it. So we went through liquidity gaps today. We talked about reversal signals, reversal bars, and different entry opportunities for those reversal bars, tick charts versus regular charts. Some volume profile stuff to better understand the liquidity gap, because the liquidity gap is the shallow part of the volume profile. And if you're thinking about trading pivots, any pivot of any kind, you really want to pick two or three reversal patterns and two or three continuation patterns and study them. There's no must have thing that you need to choose, but ones that show up frequently would be your best choice. Dojis are frequent, hammers, marbozus, those are all, they all happen a lot, right? You get a lot of occurrences. Morning star, evening star, both of those are favorites. I love them. And the swing low, whether a 2 bar or a 3 bar, those are really good. Well, I guess I hadn't heard it put that way. I mean, there's the top and bottom line of the earnings report. There's the same store sales, or that doesn't really fit Nvidia, but if there is, everything's got a widget. So with banks, it's how much money are they making on the interest. If it's something like Walmart or Domino's, whatever, is it same store sales? What's the widget? Um, yep, yeah, that's a big one. Usually in advance, there'll be Bloomberg articles, or pick your flavor. There'll be articles that explain what this particular company's earnings mean to the masses. For Nvidia, it's the representation of the AI trade. So Nvidia has to say things that convince people that the AI craze is still doing good, it's not going away, and that the money burn, one, was not in vain, and two, is not slowing down, and three, continue for X period of time to justify all the money that they've spent. But if we were looking at Walmart, they would be saying, okay, well, Walmart's really important and it's going to justify the spending continuation into Christmas, blah, blah, blah. Like every earnings has a thing. But if you're not familiar with the name, then you really want to hit those headlines. You want to check the news to find out what is this particular stock's thing and why does it matter to the market. Nvidia right now, they need to say the right things. And yeah, money's important. I can't argue against it. Money is important. But I bet they could post lackluster numbers as long as the forward guidance says the right things and they talk about the right things in the announcement in the right tone of voice. Everything would be fine because they're representing more than just, hey, we're selling chips right now, right? They're representing the whole kit and caboodle at this point. So always try to figure out what's the widget or what's the thing. And if you can't find it, don't trade it. I know it sounds kind of obvious, but sometimes not having the answer is just the tell that you need to get the hell out of the way and don't trade it. Nvidia, or not Nvidia, but Netflix, for an example, used to have subscriber numbers, used to, and everybody knew trading Nvidia, Netflix, that it was all about those numbers. No matter how poorly they did, as long as they had increased their subscriber numbers, they weren't going to crash and burn, right? So and now they don't even use those. They took them out of there. But that used to be the widget. For Tesla, it used to only be car sales. And that Tesla could have the worst numbers, but man, if they said they had increased car deliveries or increased sales, then the stock did really good. So, what's the widget? Yeah. Yep. Here's NVIDIA's IV rank going into earnings. And all those gray lines in the lower part of the chart is marking where IV was at earnings. If you look at where the IV is now, we're higher than the last two earnings, but we're lower than the average earnings. The problem is the bill's going to come due sooner or later. The spend that they're putting in, the burn rate, we used to joke about Apple being the bank of Apple because they had so much cash that they could do whatever they wanted. Well, they don't have that big old cash pile anymore. Google, Meta, those all those big capex companies that just were sitting on boatloads of cash and never had trouble. They don't have that anymore. four companies that issued bonds in 2025 out of the Mag 7. These are the four that did issue bonds. These are the three that did not issue bonds. And of course, one of them you already know is Nvidia. Nvidia didn't need to offer any bonds. This is the AI debt, right? The funding needed to keep the burn rate going. So in the game of musical chairs, the buck stops here. Somebody's going to get left without a seat. If you look at the stats, I went through the stats this morning in the morning briefing, but I added more. This is 18 earnings, 20 quarters, or yeah, 20 quarters, 18 wins, two misses for Nvidia. And the average run up, even though we added more earnings here, it's still around that 9% mark. And that's a 21-day ramp into earnings. But it's actually the outside part of earnings. When we leave to the right and earnings are over with, what's the average? The average is either a big move up or no up move at all. It beat 18 times and it only had 9, so half of that had a move to the upside greater than 5%. So when Nvidia does go up after earnings, it goes up more than 5%. When it goes down after earnings, 7 out of 9 times it moved more than 5%. So, a lot of companies, when they report earnings, they get really violent for like a day or two, and then they just mean revert right to where the earnings start was. But not Nvidia. Nvidia's got a history of making the earnings move and making it more than 5%. It just depends on how well they can talk it up. They've got a market maker move of almost $13 and an average daily move of around $5.50. That's a really big projection. Like they way overstated the potential move on this earnings release. Way overstated it. I like to trade those ramps into earnings, like the 21 days before a company reports, and then I like to wait for the report to happen and trade after the report for the next 21 days or 36 days, something like that. I really don't like to trade the report itself because it's just such a gamble. I got so many good things that I could gamble on. I'd go to Vegas, pull the slot machine, get free drinks, maybe even see the fake Elvis. Why I don't want to gamble this way. I'd rather have a good solid trade and not mess around with earnings. Oklahoma has the closest Quiznos to my house, and it's at the Hard Rock Cafe, which is a massive complex with live bands and casinos and Quiznos. Yeah, Kansas has casinos. Anywhere there's an Indian reservation nowadays, there's a casino. No, but man, you gotta love the live bands and the shows and you know what I mean? Yeah. Hard Rock Cafe, man, that's a classic. Well, thank you for making me feel better because me being handicapped and boring and old, I thought I was the only one that just wandered around watching the fools. Yeah. Well, guys, we're gonna call it quits. We'll be back to do it again tomorrow. Get the morning briefing, and we'll see what the impact is for Nvidia. They're not allowed to go out and say anything that's going to be detrimental to the broader market's bias of the AI trade. So while it could be positive or negative, and we're going to infer things from that, there's going to be some stipulations or restrictions on what they actually say. It's very likely going to be tone deaf and really positive no matter what. you know and the market's going to have to read between the lines and see how much of it they believe is true. Yeah, yeah, we just need a Nvidia whisperer. And the Fed Watch tool shows that our chances of a rate cut have dropped even more. We're at 33%. So we'll see it where we're at tomorrow after the market starts to digest this news and where we're at by Friday afternoon. That's going to be the key. Because if we're going to get any hint of a rate cut, it'll stop this drop and we'll begin to digest and maybe even begin working our way back up. I will see you all tomorrow.